price. These valuation techniques can help establish a good starting point for negotiations. For stock market investors like us, though, the answer may be, for investing purposes, I'm not sure that you should bother. We're not going to have the time or the inclination to put forth the effort needed to compete with experts who do this sort of thing for a living and are backed by big investments in technology and who have access to huge amounts of current data. But not using something isn't the same as not learning about it. Even if you decide not to use these valuation techniques, you'll go to bed at night knowing a little bit about what's hiding under the bed. You'll find that it's much less scary than the unknown. To me, though, the best reason to learn a little about valuation is to understand what drives corporate value, earnings and cash flows, and the discount rates that analysts apply to them. As we've seen, these estimates of corporate and share value are incredibly sensitive to tiny changes in the assumptions underlying the calculation. Remember how much our estimate of the value of Lowe's stock price jumped with just a tiny change in the dividend growth rate or the discount rate? All valuation approaches require data. High-end analysts spend big money to buy data from real-time sources like Bloomberg. Where can people like us get data? Unless you're prepared to spend thousands of dollars, you won't find data to match the big players. But the internet does provide a convenient way to access corporate data. One example is the Securities and Exchange Commission's Electronic Data Gathering, Analysis, and Retrieval System, more commonly known as EDGAR. The SEC requires that all U.S. corporations with more than $10 million in assets and at least 500 shareholders file corporate financial data. These data are available free to anyone with internet access. What will you find on EDGAR? You'll find hundreds of current and historical filings on just about any company you want. You'll find everything from annual reports to something called a notification of the removal from listing and registration of matured, redeemed, or retired securities, for goodness sake. EDGAR is a goldmine of information if you're willing to dig around the SEC's website. Another helpful source is Valueline, an investment advisory service founded in 1931. Lots of smart people love Valueline. Valueline has a reputation for doing careful research, and there's no doubt that the way they present the information is a big plus. In just one screen, you'll find the company's name, the exchange where it's traded, a recent price, the dividend yield, plus Valueline ratings for timeliness, safety, and the firm's technical score. You'll find more than 15 years worth of selected ratios such as sales per share, cash flow per share, and earnings per share. You'll find annual sales. You'll also find 2 or 3 years worth of balance sheet items like the ones that we discussed in our previous lecture, plus a business report summarizing Valueline's company research. Some of Valueline's resources are free, but the meat of their offerings does require a subscription. I'm a big fan of Yahoo's financial website called Yahoo Finance. A lot of the numbers I use in these lectures come from Yahoo. My students and I think that it's easier to find the information we need on Yahoo than on most other sites. That's partly personal taste, of course. And it's free. We like free. Here's an example of the information on yahoo.com from December 6, 2013. For BioCryst Pharmaceuticals, you'd have found the income statement, the balance sheet, and other financial statements. One click away is the PE of the industry, which was a very high 73. You'd have learned that the price-to-book ratio for the industry was 18.3 and the dividend yield was 1.7%. You'd have learned that BioCryst Pharmaceuticals business is battling bad enzymes that spread disease. This is a good time to illustrate how financial ratios differ across industries. Let's look at publishing newspapers. Gannett Corporation is an example. The price-earnings ratio for this industry isn't anywhere close to biotech's 73. It's just 22. Instead of a price-to-book ratio of 18.3 for biotech, TV broadcasting is negative. The PE comparison is particularly instructive. Investors are willing to pay $73 for every current dollar of biotech earnings, but only $22 for a current dollar of newspaper earnings. That tells me that investors don't think as much of the industry's future as they do biotech. The newspaper industry is probably at or past its peak. In contrast, investors predict big earnings growth in biotech. These big earnings justify the high price. Do be careful when you hear the term growth. Growth per se isn't worth buying. If we double earnings by issuing new shares to double the size of the company, then the company grows to twice its previous size, but we've cut your share of the company in half. Your stake has the same value as before. Growth is only good if the company can earn a higher return than it costs to raise the funds to operate the business. We've only scratched the surface of valuation. We barely mentioned the secret sauce that investment managers use. Partly that's because managers don't like giving away their trade secrets, and partly it's because we could literally spend years on the subject. Knowing when to apply which approach is time-consuming and tough, and that's why professional money managers make big bucks. The next time you listen to the news or check the internet for financial information, you'll encounter some of the terms we've covered today. Take a moment to think about whether what you're hearing makes sense. I'm not suggesting that reporters and their guests are trying to deceive you. They're hitting a deadline, and they have limited space and time. There's no room to define their terms and list their assumptions. Most viewers and readers wouldn't want to hear that stuff anyway. Those assumptions and interpretations are still there, though. Have the commentators picked the right tools for the difficult job of distilling a company into just a few concepts and numbers? In our next lecture, we'll study one of the most successful examples of financial innovation in history, and one that's particularly useful for people like us, the world of mutual funds and other investment companies.